Hello and welcome to Wrestling with Real Estate, where we look to chokeslam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multi-family real estate investor, Barri Griffiths. Now today we're joined by Kevin Brenner. Hey Kevin, how you doing, man?
Hey Barry, thanks for having me.
My pleasure having you. We just finished recording the first part of this two-part series, and had a great time talking about your story and what you've done and where you've progressed to, and that led us to talking about the fund that you have going, and that you know, with raising capital and being part of the syndications and all that, you guys decided to go the fund route, right? So maybe before we covered this a little bit on the first one, but just for people maybe who are just tuning into this, what is a fund to start off with? What is the idea of a fund? How does it work?
Yeah, no, great question. So again, a fund is it's a special purpose vehicle, and it's just it's a vehicle, right? It's a way for you to raise capital and aggregate capital. So if you're watching right now, you kind of have that pot of money, and I used that kind of metaphor earlier. But you have the pot of money, and you can raise it from all different types of investors, depending on how you're set up, and we'll talk about that later. But you can raise all of that money. And then what we do is we diversify that capital across multiple different syndications that we find with by building excellent relationships with some of the top operators in the nation. So, diving a little bit deeper, what I like to consider us as Nimbus Capital and each one of our funds. What we do, we're kind of like that missing puzzle piece in our preferred operators capital stacks. So, a lot of these operators have been in the game for 20 plus years. So they're not using Freddie Fannie debt. They're using, they're getting traditional private equity. I bill myself at Nimbus Capital as a micro private equity firm. And the problem with traditional private equity is they'll give you the money, but there's 1,000 strings attached and you're stuck like Pinocchio then, and all those strings, they might have mandates. They might have, they want a large share of ownership. They might do something that will kill the deal. So, from the GPs, they might get, 90% traditional private equity in the capital stack, and they gotta come up with 10%. Want $100 million deal? That's $10 million, right? Where are you going to come with $10 million? Now, a lot of these GPs are connected, so they'll be able to raise their own money through their own 506C or 506B or whatever. But if they still need more money, instead of coming to an investor who's going to put 50 or 100K down, they can come to Nimbus Capital, where we're a fund of funds and we know we're connected with them. We build a great relationship with them. We know their deals. We underwrite their deals, all that stuff. But instead of putting that 50 to 100K in, we're going to say like, hey, we really love this deal. Let's work something out where we put 1.5 in. Well, boom, that solves their problem. They need less investors to get the deal done. And it solves our problem because all of our investors want the diversification and want the direct access to these deals. And oh, by the way, I'm not the asset manager. My asset, as I said earlier in the other interview, my asset is my investors. I'm able to pour all my focus into my investors and our results, and not have to, focus on, what's going on in the dog run or the dog park or whatever's going on in some asset somewhere, the roof's leaking, or I got operators for that. Experienced operators with 17,000+ units and $1.7 billion in assets under management. I don't got to do that, but I'm able to come in and be that missing puzzle piece for them to get the deal done and work with them on terms with no strings, very little strings attached. You know what I mean? Not like the big boys or the big family offices or institutional money that comes in and says, and just, yeah, sure, we'll give you, we'll come into your deal, but our minimum is $5 million. And that usually blows it up for someone who's doing a 506C to accept a $5 million, without a side letter or without something crazy. So that's really what we do.
Very cool. Very cool. Thanks for explaining that. So what is it, the advantages for an investor, for a limited partner, if they're looking at maybe just investing in one deal with a general partnership, or investing in a fund of funds? What is the advantage to them to going with a fund?
Yeah, so the fund route is going to do multiple things for you, but really, it comes down to the investor's experience and their, how they feel about investing with that, general partner. If they have a syndicator who's out there that they really like and they've been connected with them and they want to invest in opportunity, I say go for it. You're probably going to make more money. But if you want diversification, if you want, if you've been in a deal before where a general partner and operator has told you one thing and they delivered you another thing, and you kind of got burned a little bit, and, for lack of a better term, you put all your eggs in one basket, then you might want to look towards a fund, because what we do, remember, is we pool all the capital together, and then we have built the relationships with some of the top operators. And again, these deals aren't on the MLS. They're not listed. These are all backdoor deals, broker to broker deals. We get in there early and we independently underwrite the deal. We're completely aligned. So we don't make money until you make money. So we're not making money. We have 0 fees, which is crazy, right? There's no fees. So we're not making our money off of our fees or anything like that. And we're finding the best deals for our capital and our investors' capital, and we're putting it to work. And you're getting a lot of exposure with different deals in different markets, with different operators, different strategies, whether they're value add class B, or whether it's a light value add class A, or whether it's an Airbnb large commercial multifamily arbitrage model, or whether it's a mobile home park. Like, we are across the board diversification to deals that make sense. And I think it's a great value prop for a lot of passive investors out there who kind of want a plug and play and a simple solution to the exposure that they know that they need.
Yeah, and then from the investor, it is the diversification part is huge, right? But how does it work? They want to invest. They like the idea of investing in a fund. They put, say, 100,000 in. Is there a timeline of when they have to keep that money invested? What if they want to take that money out? Is there is there a preferred return? Is it just a split? How does all of that work? Is it similar to a traditional syndication, or is it much differences?
So I could have made it as complex as a syndications out there right now, with 1,000 waterfalls and ridiculous preferred equity structures and side letters and all that stuff. But when I devised everything and we looked at who we wanted to help the most, I wanted to make it as simple as possible. So I did that. So our payment structure is straight 80-20. Everything that we get from we have the aggregated capital and we put it all in the deals, and the deals are cash flowing from day one. Obviously, they're multifamily, right? So they're cash flowing from day one. All that cash flow comes back to us, and we split it 80-20. So 80% goes to the investor, pro rata based on their ownership of the fund, and 20% goes to the GP. And we continue to scale that way. We don't have a management fee. We don't have an acquisition fee. We don't have a disposition fee. We don't have any of that stuff, because they're silly. That's it's just silly. And if you've studied the private equity space as long as I have, you'll know that people have gotten very, very greedy over the last 10 to 15 years in private equity. And I just don't think it's right for a retail investor to get burned. If just because they want diversification doesn't mean they have to pay out the nose in fees. So we're kind of turning that model on its head a little bit. As far as timelines and everything like that, if the investor listening to this wants to put $100,000 into the fund and put it to work, we are a 506C, so we have to verify your accreditation. We go through that, and it's just a simple letter from your CPA or your lawyer, and we keep that on file, and we'll do some anti-money laundering, know your customer type stuff that we have to do, and make sure we're not taking money from from Scarface or something like that. But I don't know who's listening to this right now, but can't take your money.
It's all drug dealers. That's my audience.
Yeah, exactly. So barring that clientele, we put the capital and we deploy the capital on a rolling basis. So as you can imagine, there's a timing thing here, right? It's not like we have all the deals just waiting for us and all our partners are just waiting for us. They're raising capital and we're part of their capital stack. So to give you an idea, we have 2 deals. Actually, we should have 3 deals by the time this one comes out. 3 deals identified to be put to work with funding deadlines of 1 August, so of August 1st, and that money gets put right to work, 140 unit property. And then there is I think it's a 330 unit property. And then we're working on another deal as well. So really, because all of and it goes back to our partnerships that we've built, all of our operators are really high performers. They're turning and burning, doing 4 to 6 deals a year, big deals. And that means they're constantly underwriting things. They're constantly putting stuff in front of us. And, we look at it, and if it makes sense, we're going to jump on it. And like I said earlier, the best part about investing into a fund is that you get leverage in your buying power. Well, two main reasons. You get leverage in your buying power. And what I mean by that is you invest $100,000. Say you wanted to put $100,000 into an individual deal. Great. You put that into a deal, you're going to get charged a management fee. You're going to get charged an acquisition fee. You're going to get charged a dispo fee. You're going to get charged all that stuff because you're just an average Joe investor. But if you put it into a fund that goes and says, hey, instead of putting 100,000, the fund says, instead of putting 100,000 in your deal, I'm going to put 1.5 million into your deal. We set up side letters, exclusive shares. So we don't pay the management fees, or we pay way less. So instead of a 3%, we might be paying them 1%. Like, I understand they got to keep the lights on, but we're not going to pay an acquisition fee. We're not going to pay the disposition fees. We're going to get into the deals, and we are helping them in a big, big way. And we're rewarded. And because of that, that helps boost our returns at the fund level, and it helps protect our investors. So that's the first way that the fund of funds is great. Then also, if you look at the risk profile, again, you put $100,000 into a deal. If that deal goes sideways, you're screwed, right? But if you put it into a fund that is invested and built partnerships with some of the top operators like we have, who have gone full cycle multiple times and been in the business forever, then we know that they're going to perform, and you're hedging your risk in a big way, because even if one deal goes down, you still got 3 or 4 others, whatever else the fund is invested in. And we strive to put this fund as a $5.1 million fund. And we're going to split that across 4 to 5 deals. So about $1 million in each deal, right, that we're putting in. And that will hedge a lot of risk, because these deals are, again, different markets, different operators, different strategies, all multifamily, but just very niche down. And it's a great way to, again, get a lot of exposure very simply.
Yeah, and I think another good thing about the fund is, as well, is that they don't have to bet every deal, every syndication, right? All they have to do is, once they feel comfortable with you guys and they believe in you guys, and they know that you guys is the right place to fit, you guys are doing all that. You've vetted all these,
Yep.
GP groups already, and you vetted, you vet the deal on a deal by deal basis. They don't have to worry about that. They invest the money in whatever it is, like you said, maybe that 100,000 into the fund. Then it's your job, right, as the people running the funds, to do all that, right? And then they leave it into your hands, and it takes that stress out, and they get to, how else could you spend 100,000 and be invested in maybe 5-10 deals, right? Invested across the board in different kind of asset classes. You
wouldn't meet the minimums. And then remember, at the fund level, you said it's our job, Barry. That's our only job, because we're passive in these deals. So our only job, we're not distracted by all the other aspects that your regular syndicator is distracted by. Most syndicators don't like raising capital because it's an afterthought to them. They're worried about finding deals, underwriting deals, working with lenders, blah, 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 all this stuff. We don't do that. I don't got time for that. My focus is vetting the deals, making sure they're right for the fund, and communicating that to our investors. And if you go back to the original part of this interview, I said that I hate asset management. I do, but now my assets are my investors, and I love working with people, and I love helping them achieve their goals.
Very cool, very cool. And out of interest, why do you guys go for a 506C rather than a 506B?
Yeah, so the 506C, obviously the main one is that we're able to market it freely. We're hamstrung by who we can take money from, but in my capital raising experience, I find generally accredited investors, while they are harder to find sometimes, if you're not focused, if you're not laser focused on your avatar, then while they might be harder to find, they're usually easier to communicate with, because they usually have some exposure already, and they understand things because they've reached that accreditation step. Now, the folks that we focus on, those real estate professionals, the realtors, lenders, and brokers, they might not have any exposure. So we're taking that burden and we're educating, and we're putting that information out there. But that's not to say we don't have clients who are professional athletes or just traditional investors in any sense of the word. If it's a good fit for you, then what we offer is a good fit, and what you have is a good fit for us at the right time, then we can make something work. Yeah, I mean, it's the 506c definitely helps eliminate some more red tape.
Yeah, I'm sure. Yeah, I'm sure it is. And like you said, it's if you're accredited, it's a lot easier to probably talk to these people, right, and have them understand what a great investment this is. This is so interesting, though, the fund of funds and how it works, and just the whole dynamic of it is really interesting. Is there anything that I didn't touch on or I didn't ask, or that maybe you feel people should know about it?
No, I mean, we kind of touched on the basics here and how it works and how the capital is split up and everything. And just like any investor, you got to do your due diligence, right? You got to make sure that I'm not going to be taking your money to Aruba and like going and spending it. It's not, it's not how it's going down. But you got to know, what you're looking for, and you got to know your criteria and what your financial objectives are. And if your financial objective is you want an easy way to diversify a lot of capital into a lot of different deals with some quality operators, then the fund of funds might be the route for you. And the one thing I didn't really mention is the timeline on all of these deals. We operate on a 5 to 7 year timeline, but because we're invested in different deals at different times, you might get your big check sooner. Say one of our partners, for example, they focus on turning deals in 3 years because they come in and they do a value add, but on the management side. So they're, fixing the operations, fixing the management. They're not doing the physical repairs. They're selling it to someone else who wants to do the physical repairs once they really get it squared away. And that allows them to turn and burn through a lot more deals, which is great. And it gets investors, their principal back faster, which means their returns are higher. So, understanding that time value of money is crucial when you're getting into this. But again, the way it works out and the timing of it all, it's a great way to get a lot of exposure and create a long-term passive income, one fund at a time.
Very cool. Very cool. Well, man, thank you for taking the time to explain that and talk about that. It's, like I said, it's such an interesting concept. And I think it is, like you said, I think on the previous episode, it's the future of where these deals are going and how things will operate. So I appreciate you explaining that to a lot of people, because I'm sure they'll be quite eye-opening, right? Or ear-opening, maybe, as they're listening to this. Yeah. But if people want to find out more about what you guys have got going on and maybe, be involved in a fund or funds, whatever that might be, how can they get in touch? How can they find out more?
Yeah, Barry. Again, you guys can just reach out to me, Kevin at Rise with Nimbus, RISEWITHNIMBUS.com, or just go to our website, www.risewithnimbus.com. There's going to be a little Facebook Messenger thing that pops up in the corner. Go through that little Facebook Messenger bot. It's 7 questions. It ends in my. You can book a call. We'll talk all about it. Trust me, I'll talk your ear off. And do that, and we'll see if Stratus Fund 1, this first opportunity, is a right fit for you.
Perfect. Well, thank you so much, man. Have a great rest of your day.
Thanks, Barry. This is fun.